Happy Thursday out there, Team 42. It's your skipper here, Darius to present our macro minute for Thursday, December 19th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro questions are twofold. Number one, does the Fed still have an asymmetrically dovish reaction function? And number two, is U.S. liquidity still on track to be supported by $700 to $800 billion of Treasury Journal account spend down early next year? Our answers are the Fed's reaction function is still unquestionably dovish, but it is not likely asymmetric anymore. Indeed, yesterday's FOMC decision in Powell Presser contained several overt and subtle shifts that signaled the Fed is content to relinquish its asymmetrically dovish reaction function. We were keen to highlight the systemic risk associated with the Fed ending this condition in yesterday's leadoff morning note. And asset markets responded overwhelmingly bearish to the initial indications of this policy pivot. Investors must remain on high alert for a potential row phase transition in short order. As we stressed in our December 2024 macro scouting report and around the horn presentations over the past couple of months, the area under the left side of the aforementioned probability distribution continues to rise. We continue to view a trending risk-off market regime as a high probability outcome starting no later than mid-2025. If you have learned anything from our successful navigation of asset markets over the past 3 years, it is that you should feel confident that our systematic risk management overlays, aka KISS and Dr. Mo, will do as good a job of helping 42 macro clients minimize downside capture in bear markets as they do helping them maximize upside capture in bull markets. Lost in the fray of yesterday's FOMC-inspired bloodbath was the significant development regarding the sequence of President Trump's policy agenda. Specifically, his decision to use this dominance of the Republican Party to influence an earlier debt ceiling vote or scrapping the debt ceiling altogether risks nullifying the potential $700 to $800 billion of TGA spend down we currently still anticipate in the first 3 to 4 months of 2025. Nullification is explicitly bearish in the context of a too strong U.S. dollar that further tightens financial conditions by incrementally draining liquidity. All told, we believe the brewing storm around a potential government shutdown and President Trump's disdain for the recent stopgap funding bill and debt ceiling process altogether is more noise than signal. It may, however, become signal to the extent congressional Democrats find it prudent to raise or eliminate the debt ceiling during President Biden's final month in office in exchange for securing a portion of their policy priorities now. Transitioning to our 42 macro dashboard, as always, a wrap up with a question from our community. This one's regarding year-end performance chase. Hello, Skipper. Given the FOMC data projections, you are still given the new FOMC data projections, are you still expecting a performance chase into year-end, further into Q1? Should we rather be starting to think and get defensive? Had the shift from Fed focus on maximum employment to focusing on inflation concerns occurred? So all great questions. I'll start by saying, with respect to year-end performance chase, we've been anticipating a year-end performance chase since the summer when everyone was panic selling lows, when the bear porn purveyors were coming out of the woodwork with their hard landing fears and the yen carry trade notes and everything and scaring gullible retail investors into subscribing to their bear porn newsletters. So that's when we started anticipating a year-end performance chase because we ultimately knew that, or at least we ultimately thought that investors would ultimately buy the dip and incrementally be forced to chase the market higher in the raging bull market that we called for this year. So we've been in the year performance chase, which was obviously we had gas to that fire to some extent vis-a-vis the election results and the animal spirits that came alongside that. So I want to take this time to say we've been in the year in performance chase, trying to anticipate how asset markets trade between now December 19th through December 31st is worse than a fool's errand. At least a fool can make money here and there in financial markets. I think if you're trying to trade on this sort of a time horizon, you're doing yourself, your family, and or your clients a significant disservice by being so hyper focused on the short term. And this is, one of the many behavioral heuristics that we coach investors out of here at 42 Macro. So if you're thinking about managing risk in your portfolio, going back to the kind of the second part of the question, should you be thinking about getting defensive? Should you be thinking about getting defensive? It's nothing to do whether it's year-end performance chase season or if it's February or if it's April or if it's summertime. There's all you can create a narrative around anything, but what really matters in terms of your asset allocation and portfolio construction in your portfolio should be your quantitative risk management signaling. obviously Kiss and Dr. Mo guide our quantitative risk management signaling for our retail investor clients and our institutional investor clients. But you might have your own quantitative risk management signaling. I think a 50-day, 200-day moving average crossover, which is probably like the lowest hanging fruit of risk management signaling, is better at managing risk than the average person's thoughts about things like year-end performance chase or Fed pivots or focusing on inflation or employment. The reality is those, the fundamental part of your process, things like what's happening with the year-end performance chase or what's happening with the Fed or what's happening with fiscal policy, TGA spend down, all these different things that we talk about here really help you anticipate the evolution of your risk management signals, such that when you get a change in your risk management signals to take up risk or take down risk, to get incrementally short or get incrementally long, those types of those types of signals, you need the intellectual confidence and the emotional confidence in your gut to respond to the signals with the appropriate pivots in your portfolio. That's why we talk about everything we talk about with respect to growth, inflation, policy, monetary policy, fiscal policy, liquidity, positioning, sentiment. All those things help us sort of build the distribution of probable economic and financial market outcomes in our head, and they also help us to develop the emotional confidence associated with the likely path of our risk management signals, such that when we get a change, we're comfortable making the change in order to remain on the right side of market risk. This is what I'm about to go head into Midtown Manhattan, go on TV and meet with a couple of clients, in the hallowed halls of Midtown Manhattan. And the reality is, this is what they're doing. They're not out there going, well, Jay Powell said this, now I got to get defensive. They may get defensive, but it won't be in response to what Jay Powell said. It'll be in response to some risk management signal in their quantitative risk management signaling process triggering. And so we want to make sure that everyone, even if you are a retail investor, you're in Main Street, our service exists to make sure that you have access to the types of process, institutional research and risk management process that the folks over at Midtown have, and so you can produce great and superior results of your portfolio or your client's portfolio. So we'll wrap it up there. Darius Dell, catch me on Fox Business this afternoon at 2:30. I'm joining my main man, Charles. We're going to talk Fed for turning 2025 outlook. So that's going to be another great session. Really, really grateful for that opportunity. So I will catch you back here tomorrow. Actually, no, I won't be here tomorrow. I will be here on Monday. I'm going to be offline tomorrow. So I'll catch you back here on Monday. Everyone have a wonderful weekend. Cheers.